Let's start with a quote that basically sums up the entire strategy. This is from Warren Buffett, a guy who has built an absolute empire by navigating more than a dozen of these downturns. He doesn't see a crash as a disaster. He sees it as a clearance sale, where the best assets in the world are suddenly marked down 50% off. This mindset, seeing a massive opportunity where everyone else is seeing panic, that's the fundamental difference between people who lose money and people who build dynasties.
All right, so here's how we're going to break it all down. First, we'll look at the two totally different playbooks, the one for the public and the one the wealthy actually use. Then we'll take a peek at their secret shopping list to see what they're buying when everyone else is selling. We're going to uncover why cash is their secret weapon and why so many eyes are on 2026 as the next big opportunity. And most importantly, we'll get into how you can use a scaled-down version of this playbook before we talk about the massive wealth transfer that's just over the horizon.
Okay, let's start with the absolute core of this whole thing, the mindset. Because during a recession, the entire financial world really splits into two camps. And they're not just using different strategies, they're literally playing a different game with a different set of rules.
And here is that difference, side by side. On the left, you've got the playbook that we're all taught. Play defense, right? Hunker down, stuff cash in a savings account, avoid risk at all costs, and just wait it out. It feels safe, it feels responsible. But on the right, you have the wealthiest playbook, and they are playing offense. They're preparing cash not to save it, but to deploy it. They are actively hunting for bargains created by the panic, and they embrace the very volatility that terrifies everyone else. Why? Because they know volatility is what creates the discount in the first place.
So if they're playing offense, what are they actually buying? You know, it's a common myth that they're just snapping up some cheat shares of their favorite tech companies. The reality is so much more sophisticated. They have a pre-made shopping list for a huge range of assets, and they are ready to go the second fear floods the market.
And this list, it really shows you how deep the strategy goes. I mean, sure, undervalued stocks and real estate, those are the obvious ones. But they're also hunting for distressed businesses and their debt, which you can often buy for pennies on the dollar. They're targeting things that spit out cash, like solid dividend stocks. They even look at luxury hard assets. Think fine art, rare watches, classic cars, things that hold their value when paper money gets shaky. You see the common thread here? Every single one of these assets gets priced based on the seller's desperation, not its true long-term value.
Now let's just zero in on one of the most powerful moves on that list, buying distressed businesses. See, a distressed company isn't just a failing business. It's usually a company with real solid value, but it's facing temporary and often fixable problems. The best analogy? It's like a beautiful historic house with a leaky roof in a neighborhood where everyone is panic selling. A smart investor doesn't see the leak. They see the incredible bones of the house and know they can fix that leak for cheap.
And this is so important. They aren't buying the company as it is. They're buying what it could be. They're looking for that hidden value. Is the problem just bad leadership that can be replaced? Are there markets the current managers are totally ignoring? Can they just slash bloated costs? Maybe the company owns some incredibly valuable patents or real estate that's being mismanaged. A classic example is the investor Carl Icahn. Back in the 80s, he went after the airline TWA. It was bleeding cash, near bankruptcy. But he saw valuable assets and a crazy cost structure. He took it over, slashed costs, and sold it years later for a huge profit. He bought the potential, not the problem.
This whole process creates multiple ways for smart investors to get in the game. When a company gets into trouble, it might have to restructure or even declare bankruptcy. But for an investor, bankruptcy isn't the end. It's an open door. It's their chance to swoop in, buy the company's debt for dirt cheap, and effectively take control. Then they can reorganize it to make it profitable, merge its best parts with another business, or just sell off the assets, often for way more than they paid. Every single one of these paths can lead to a massive payday for those who are prepared.
Now, beyond buying whole companies, there's this laser focus on steady, reliable income. Because in a downturn, cash flow is king. High-quality dividend stocks, especially in those boring but essential sectors. Think healthcare, utilities, things people need no matter what. They provide a constant stream of cash. And that cash does two really powerful things. First, it cushions any losses in your portfolio. But more importantly, it gives you fresh capital that you can immediately reinvest to buy more shares while prices are still in the gutter. It's a strategy that just pours gasoline on your wealth growth when the market finally turns around.
And that brings us to the most misunderstood tool in the entire playbook: cash. We've all heard that phrase, cash is king, right? Especially during a recession. And it is, but not in the way most people think. For savers who just let it sit there, it's a trap. For investors who are ready to deploy it, it's a weapon.
See, the problem is something psychologists call the money illusion. We look at our bank account, we see a number, say $100,000, and it feels solid, it feels safe. But that number is a complete distraction. What really matters is what that money can actually buy. The best way to think about your cash savings is like a melting ice cube. The number of dollars might stay the same, but its size, its real purchasing power, is shrinking every single day, just quietly vanishing because of inflation.
In the math on this, it is absolutely brutal. Let's say your high-yield savings account is paying you 2%. Feels pretty good, right? But if inflation is chugging along at 4.5%, you're actually going backwards. You are losing 2.5% of your wealth, your real buying power, every single year. You are literally paying for the feeling of safety, and the price is a guaranteed loss.
And let's put that in real dollar terms. Just look at this number. If you start with $100,000 in cash, after only 5 years of totally normal inflation, its real buying power has shrunk to about $81,000. You've lost nearly $20,000, not from a bad investment, but from doing absolutely nothing. That is the hidden tax you pay for playing it safe.
But for the wealthy, cash serves a completely different purpose. It is not for saving, it is for spending. They call it dry powder, a strategic reserve of ammunition they stack up during the good times, just waiting for the perfect moment to strike. So when panic hits, and everyone else is forced to sell their best assets just to raise cash, the prepared investor steps in with their dry powder and scoops up those exact same assets for a massive discount.
So why are we talking about all of this right now? Well, it's because many experts believe we are getting very close to one of these major opportunity windows. Specifically, there are a number of signs pointing to the period around 2026 as a time of major economic turbulence and therefore a major opportunity for anyone who's ready.
So what are these warning signs? Well, for one, author Robert Kiyosaki has been very vocal, predicting a global recession could really take hold in 2026. And he points to things we're already seeing: major layoffs across both big corporations and small businesses, combined with stubbornly high interest rates that make it expensive to borrow money and really put the brakes on the economy. You mix all that with global uncertainty, and you've got the perfect cocktail for the kind of volatility that creates what he calls deals of a lifetime, especially in things like real estate.
And this all leads to a phenomenon we call the K-shaped recovery. After a recession, it's like the economy literally splits in two. The top arm of the K, that represents the asset owners, the investors. Their wealth, which is tied to things like stocks and real estate, often shoots straight up and becomes even greater than it was before the crash. But the bottom arm of the K, that's the wage earners. Their income pretty much stagnates or even goes down as they deal with job losses and instability. This isn't just an economic trend. It's a moment that radically reshapes and widens the wealth gap for an entire generation. Okay. This all sounds great if you're a billionaire. But what about the rest of us? How can we possibly apply these same principles on a smaller, more practical scale? Well, the good news is the logic is totally scalable. You do not need $1 billion to adopt the billionaire mindset. A really practical way to do this is with something called the barbell strategy. I want you to picture a weightlifter's barbell. It's got heavy weights on both ends and nothing in the middle. Okay, so on one end you have extreme safety, 6 to 12 months of your living expenses. But instead of a melting ice cube of cash, you hold it in something that actually fights inflation, like short-term government bonds or T-bills. That's your foundation. That lets you sleep at night. Then on the other, much bigger end, you go for aggressive growth by systematically, automatically investing in the broad stock market, like an S&P 500 index fund. So here it is, your 4-step offensive playbook. Step 1, automate your investing. Use something called dollar cost averaging. That's just a fancy way of saying you invest the same amount of money on a regular schedule, like every 2 weeks. This simple habit forces you to buy more shares when prices are low and fewer when they're high. It turns a market crash from something to fear into your absolute best friend. Step 2, prepare your shopping list now, before the sale starts. Know which great companies or funds you want to own. Step 3, fortify your income. Your ability to earn money is your single greatest asset, so invest in your skills, especially in recession-proof fields like healthcare or tech. And finally, step 4, consider owning some real assets, things like physical gold, silver, or even a little bit of Bitcoin as a hedge, just in case.
Which brings us to our final and maybe most crucial takeaway. When you really zoom out and you look at economic history, you start to realize that these cycles, they aren't accidents. They are an inevitable, predictable feature of the system. And every single time one happens, it triggers the same dramatic event.
This is probably the most important thing to understand from all of this. Wealth doesn't just disappear in a recession. It moves. It is transferred from the impatient to the patient, from the reactive to the proactive, from the unprepared who panic sell to the prepared who are ready to pounce. The people who are selling their assets in a panic are basically handing them over at a massive discount to the people who have been patiently waiting with a plan and a pile of dry powder.
History tells us that another one of these massive transfers is coming. So the only real question is, which playbook are you going to be using when it gets here? Are you going to be hunkered down, just watching your hard-earned savings become a melting ice cube of lost buying power? Or are you going to be the one who's ready with a shopping list, prepared to seize the opportunity of a lifetime? The choice is yours.